welcome to episode 96 of the Rewarding Property Decisions podcast. So I just wanted to start today off by saying a big thank you to Jordan Telfer and Fran Gallooni for last week's podcast. Hopefully that gave you some really good insights into how valuable property managers are and how to make the most of using their expertise with your investment properties. Now, over the last week, as most of you will have no doubt seen, there's been a hell of a lot of talk around property from a number of different fronts, but particularly from an affordability perspective, it's been a very hot election topic. Both the Prime Minister, Anthony Albanese, and the opposition leader, Peter Dutton, have put forward proposals in the last week or two in terms of what they're proposing their policies, what property policies will be for the election, which has been really interesting. And then you further that with the interest rate cuts and how or the potential interest rate cuts and how they've been brought about with Donald Trump threatening to put tariffs on anything that moves. And we're really starting to see that all of a sudden we've gone from maybe one interest rate cut and maybe another one later to talk of potentially 5 more interest rate cuts this year. So things have developed and have changed dramatically in a fairly short space of time. So I thought we'll give you a bit of an overview as to what we're seeing in the Melbourne market as well. But first and foremost, just to have a bit of a look at some of these factors that are impacting the market at the moment or likely to have some form of impact. So if we look at the policies from both parties, if we look at the Labor parties first, their policies for the election come about in 2 forms. The first one is to expand their existing first home buyers guarantee. Now what that is allowing first home buyers to purchase property with only a 5% deposit. So what the government effectively does is becomes guarantor. So typically if you aren't able to have 20% up front and borrow 80%, if you're needing to borrow in excess of 80%, most banks will require you to take out lender's mortgage insurance, which obviously increases your monthly repayments even further. So by the government stepping in, they take out that necessary need for lender's mortgage insurance. And that's been in place for some time, but they're looking to expand on that. So it is currently means tested and it's currently available to 50,000 applicants per year. So the plan would be to remove the means testing and also to remove the limited number and also to alter the current restrictions on price. So at the moment, for Melbourne, it's up to $800,000. That would be increased to $950,000. And the plan would be to commence these changes as of the 1st of January 2026, so next year. The second part of the plan is to spend about $10 billion to help build 100,000 new homes. But they would only be available for first home buyers. So that one is likely to become income tested just to determine who would be eligible to buy these homes. And that would most likely commence around the mid part of 2026. And then obviously depending upon how long legislation and construction takes, those homes would hopefully be available over the coming years from there. From the coalition's perspective, they're likely to, what they're wanting to do is allow first home buyers who are looking to buy new homes to deduct part of the interest paid on their mortgage from their income tax. So effectively a form of negative gearing. And it's a bit like, owning an investment property. What they would be calling that policy is the first home buyers mortgage deduction scheme. And it would be limited for 5 years of your the mortgage length that you've taken out. So quite commonly a 30-year mortgage, you would only be able to make those claims for the first 5 years. You can only claim back the interest paid on the first $650,000 of that mortgage that's being paid. But there is no limit to the purchase price and there is no limit to the size of the mortgage. It's just that you can only claim those deductions from the first $650,000. Now this one will be means tested at for $175,000 for singles or $250,000 for couples. Now, as I mentioned, it's only for those first home buyers that are purchasing new build homes. Now, and the coalition's claiming obviously that will boost construction activity and supply levels as well. Now, they've proposed that if elected within 100 days of being elected, that they would introduce that legislation to be passed. So that's the planned timeline from their perspective as well. So how do we view those? Well, as with most of these, it's always with good intentions. Everyone is trying to help. They're wanting to try and make things better and make it easier for first home buyers to get into the market. But the problem in most of these instances, and we've seen it time and time again, which I'll go over shortly, is that when looking to assist the buyer, you are going to increase people wanting to get into the market. And what that does is then increase demand, which obviously increases prices, which increases unaffordability. So when you focus predominantly on the buying side of things, that's the negative side of it. Obviously, the 100,000 homes to be constructed as part of the Labor Party's policy would be helpful, but that's going to take time to come into play as well. By the time they actually start this, which is mid next year, that's still going to then take time to build the homes, and that's providing that everything goes to plan and everything moves as smoothly as possible, which is not probably likely to be the case. So, as I said, with these first home buyer schemes, which have been going for a lot longer than I've been buying property and probably a lot longer than I've been alive, but every time these are introduced and they assist and they help people to get in, but they push the prices further up, and it puts more and more pressure on. So it may help more people to get into the market, but it can also lead to people having to take out higher mortgages because the property that they need is at a higher price point. So these are the things that we need to bear in mind. From the interest rates perspective, which has obviously been another hot topic off the back of the tariffs that the US government has been putting in place on many countries. What that's meant is that the Reserve Bank is very mindful, and they've changed their tone, and a lot of the economists have changed their tone on the expectation, what's therefore now likely to happen around interest rates and the movement. There's been a lot of uncertainty around, and the Reserve Bank's been keeping a close eye on that, according to a lot of their commentary. Also, according to a recent ANZ Roy Morgan survey, consumer confidence has fallen 2.6 points over the past 2 weeks or so, which has dropped it down to 84.2, which is significantly lower than the average that's been sitting at around 109.7 since 1990. So if you look at their scaling, it goes over that period of time, and it's consistently, the average has been at 109. So the consumer sentiment at the moment is not overly strong, hence the thought process around cutting interest rates further. So it's fairly pessimistic at the present time. Further, money markets are fully pricing in a 25-point cut as of May 20 this year, which is when the Reserve Bank next meets. So that's a significant change from earlier this year. And there's even talk that there's a 1 in 3 chance of that being as much as 50 points rather than just the 25. And then further to that, a total of 5 to 25 points cuts are being priced in by the end of this year. So that would drop the cash rate down to below 3%, which is a significant change. And obviously, when you see these sorts of changes and interest rates coming down at that sort of speed, that's when we do start to see it having an impact on prices. When it's one here and there, one interest rate cut here and there, it's never as much. But when it starts to come down fairly consistently over a short space of time, that's when we'll start to see it have an impact on the property market. So what are we seeing on the ground? Now, we've had some really interesting conversations within our team and within our property meetings since the start of this year. And things have certainly opened up in 2025 very differently to how they closed prior to Christmas in 2024. And we're noticing that the competition's really starting to increase. So through the back end of 2024, the back half of the spring market and leading into Christmas, clearance rates were dropping to in the early, sometimes mid, but predominantly early 60% mark, which was not unexpected, particularly coming through the back of a higher supplied spring market. But then once this year opened up, it opened up in the mid to high 60s, and it's now pushing towards a 70% clearance rate. So what we're seeing is that properties that were having one, perhaps two bidders at auction are now seeing 2 to 3, or in some instances even 3 to 4. And it's not really a specific property type either. We're not just seeing houses or just townhouses or family homes or terraces. It's a variety of property types. And it's because it's not such a specific buyer profile, it's feeling as though it's more being targeted at higher quality, higher end properties. So that could be a 1-bedroom apartment, a high quality 1-bedroom apartment, or a high quality house, or it could be some really well positioned land, which I'll get to in a minute. So the focus has been more on what the quality would look like, And that's where the interesting factors come into play. So from a feet on the ground assessment, I attended an auction, it was about 2.5-3 weeks ago now, of a one-bedroom apartment in the inner eastern suburbs. Now, there was a really good crowd at this for a one-bedroom apartment, and predominantly first home buyers that were looking at it, with some having some assistance from parents. A crowd of about 60. Initially, this property had been quoted in the high 4s to early 500s, but the quote was stepped up during the campaign due to interest levels. And by the time we got to auction day, they ended up having 5 bidders. And from speaking to the auctioneer afterwards, he mentioned that there was certainly a couple more that were intending to bid but didn't get an opportunity to. And of those 5 bidders, the property ended up selling for $670,000. So for a one-bedroom apartment where they've been, and it was a pretty special apartment in a great location, nice little courtyard, but it still shows you that for high-quality property, it's not just about the type of property, it's about the quality of the asset. And further to that, I found really interesting, because what we've been noticing over probably the past 2 years is that properties that have required work or construction sites, that sort of thing, that sector of the market's been quite dormant. There hasn't been a lot of activity there. But again, I attended an auction about 2 or 3 weeks ago, and it was really interesting. So this was a property that had a house on it, but it was in fairly modest condition, and there was discussion that I had with the agent around who were the buyer profiles that were interested, and he said he'd had a cross-section of those that were planning to renovate the house, but because there were no heritage controls on it, there were also others that were planning to demolish the house and construct a new dwelling on it. So there was a variety there. Now, the really interesting part here was about less than a month prior to the auction that I was attending, there was a near identical property that sold on the same street. So this property was on the same side of the street as the one that I was looking at, had the same land size, had a house in similar condition that was valued, that some added value, some thought didn't add any value. And that one sold with limited interest, passed in at auction, sold afterwards for 1.67 mil. Now, the day of the auction of the property that I was in attendance for, there was a crowd of over 50. In the end, there was 5 buyers that were bidding on this property, and it sold for just short of $200,000 more than what the previous one had sold for. Now, that reflected probably more that the previous property had sold really well, and so the buyer there had got great value, rather than this one being ridiculously overpriced. But it was showing that there was momentum and that there was interest there that perhaps should have been, but wasn't there only a month earlier. And it's very typical of a housing market on the turn. So when we see these things start to change, it's usually an indicator that the market's starting to move. And what we do typically see is that it's the high quality properties that move first. So this property, even though the house wasn't great, it was in a really good quality street, really well serviced, nice streetscape, good access to services, good access to public transport, just a really, really good property. So in a subdued market, and in a market that's perhaps a little bit flat, you tend to find that buyers obviously feel as though they've got the upper hand. They can dictate terms, they can really push hard from a negotiation perspective to vendors. But as the competition starts to rise, the prices might start to tick up. And as a buyer might miss out on 2 or 3 properties, whether that be at auction or they might submit offers and get beaten, then it starts to create doubts. And then they start to think about, well, maybe I'm going to get priced out of this market, maybe I need to compromise. So the high quality properties are starting to move. People who are perhaps priced out of, or feeling as though they might be getting priced out of some of these properties, start to step down, and they'll start to look at where they can perhaps compromise. And that compromise can come in many forms. It can be location, it can be the improvements, it can be style of property. We did a podcast on that only a few weeks ago. But that compromise then means that these buyers are starting to take a step down in the property market. But by them going down, they take their higher funds down into that sector, and that creates more competition in that sector of the market. So all of a sudden you get this flow-on effect. And when you get this flow-on effect, that starts to gain momentum across the board rather than just in the premium or what might be the high quality properties. And that's when things start to move more consistently. Now, at this current point in time, we're not feeling as though prices are really starting to jump and take movements, but the competition is definitely starting to rise. So the next step typically is that prices will start to move when the competition's going the way that it is. And if we do see interest rates come back further over the next 6 to 9 months, and there's further volatility in the share market, we tend to find, and it's not always the case, but on a historical sense, we've seen that when the share market does start to have a bit of volatility, people look for what might be considered a more stable asset to invest in. Gold's always popular in that regard, and then property becomes part of that as well. And so people, if they start to lead into property, that might create more and more competition as well. So just something to keep in mind. Now, so I spoke, I think it was just prior to spring last year, in the Melbourne market, about how we felt as though the Melbourne market was undervalued at the time, and that there were some really good opportunities to be had. And I still feel as though this is the case. But at the time, I also said that I felt the market would be subdued probably throughout 2025 as well, and that it would start to build momentum depending upon what happened with interest rates. I still feel that's the case, and I still feel as though it's not going to be an immediate turnaround. However, it could be coming sooner than I did initially think. So it's something to be very mindful of and to be watching pretty closely. Anyway, that's it for episode 96 of the Rewarding Property Decisions podcast. Thanks very much again for joining me. As always, please feel free to share the podcast far and wide with family and friends, and obviously on the social media channels if you can. That would be great. Otherwise, if you would like further information on making rewarding property decisions, please visit our website, wakeland.com.au. Otherwise, we wish you all the best with your property decisions.